Okay, you're good to go.
Good morning, everyone. Welcome to the December 14th, 2020.
Alice, you're on mute, sorry.
Thank you, Erin, because I was reading my notes. I was ready to go. Good morning. Let's try this again. Welcome to the December 14th, 2023 Connecticut Paid Leave Board of Directors meeting. I'd like to call the meeting to order. It's now 9:01. Amber, would you please take attendance?
Happy to. Thanks, Alice. All right. Ava Bermuda Zimmerman. I don't think Ava has joined us yet, but I'll circle back in just a moment. Andrea Comer.
Present. Good morning.
Sheila Hummel.
Present. Morning.
Ellen McKitterick.
Present.
Alice Pritchard.
Present.
John Scott. I don't believe John has joined us yet, but I will circle back. Mike Soltis.
Present.
Molly Weston Williamson.
Present.
Holly Williams. Holly Williams.
Present.
Janae Woods Weber.
Present.
Justin Zartman.
Present.
Okay, I'm going to circle back real quick. Has Ava joined us yet? I don't believe Ava has joined us yet. And John Scott, has John joined us yet? John has not yet joined us yet, so we'll keep an eye out for them in the waiting room, but we do have a quorum. Thank you.
Amber, just for the record, can you note the people we know weren't coming? So
Yes.
Fran, Isha.
Yes.
Please just note for the record who is not here.
Oh, apologies. Let's see. So Isha Canada, Adrian Cochran, and Fran Pastore will not be joining us today.
Thank you.
Thank you, Amber. I'd also like to thank the members of the public who have joined us today for the meeting, and we're going to jump right into the work of the day. May I have a motion to approve the November 9th meeting minutes, which we distributed last week?
This is Justin, so moved.
Thank you, Justin. Can I get a second?
Mike, second it.
Thank you, Mike. Any corrections or further discussion? Great. All in favor?
Aye.
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 Any opposed? Any abstentions?
I'm abstaining because I wasn't at the November meeting.
Thanks, Molly. Anybody else? Wonderful. Okay.
Also, I'm sorry, also abstaining.
Okay. Sorry, Andrea. We got you. Okay. Motion carries. Thank you so much. We have representatives here today from Markham to provide us with a presentation of the audited financial statements for the fiscal year that ended in June 30th of 2023. So we want to turn the floor over to them and look forward to their presentation. Thanks so much.
Great. Thank you very much. And good morning, everyone. Thank you for the opportunity to present our audit results. I'd like to have Damian Kogel, who's the director, share his screen, and we'll walk you through this presentation. I'm Chris Jackson, by way of introduction. I'm the audit partner on the engagement for the last 3 years. We met with the Finance Committee back on November 17th, and we have a streamlined presentation for you this morning. So members of the Finance Committee will hopefully be happy. That's a little shorter. So that's the goal here. The first slide will go through the agenda of the items that we will cover this morning. Feel free to ask us questions. We're going to summarize our auditor's report and then cover some financial statement highlights. And with that, we'll jump right into the presentation.
Just confirming that you can see my screen.
We can see it, Damien. Thank you.
Okay.
All right. The next page is where we're describing our auditor's report, and the audited financial statements that were issued on November 8th contained an unmodified audit opinion, which is the highest level of audit assurance. Also, in accordance with government auditing standards, we issue a combined report on internal control over financial reporting and on compliance. And I'm pleased to report that there are no material weaknesses or instances of non-compliance in that report. The financial statements also include management's discussion and analysis, which provides commentary on the financial statements, in addition to supplementary pension and OPEB schedules that are required under the governmental auditing standards. I'm pleased to report also that the financial statements are fairly presented, include all of the required disclosures. And we'll just briefly go through some of the main areas of focus in these financial statements on the next slide, starting with contributions. contributions receivable, and that reflects the amounts recorded on the authority's statement of financial fiduciary net position at the end of each year. The 2023 amounts represent contributions that were collected by the authority in July and August of 2023 related to payroll periods prior to July 1st of 2023. So it's based on subsequent cash receipts. The increase in contributions receivable is in line with the increase in contribution revenue of approximately 7% in 2023 as compared to 2022. There is no allowance for uncollectible contributions receivable since the receivables were based on actual amounts collected subsequent to year end. So there's no credit risk related to these collections. So that's really the top line driver of revenues. The next slide will briefly go through claims expense and reserves. The authority recorded claims expense of $314 million in 2023 as compared to $144 million in 2022. And that increase, as I'm sure everyone is aware, relates to the fact that there were only 6 months of eligibility for claim benefits in 2022, whereas 2023 represents a full year worth of claim activity. Actuaries from Spring Consulting prepared the actuarial evaluation report that went through the methodology and calculated reserves of $52 million as displayed in the left-hand column of the table. That amount is broken into 3 different categories, which are summarized in the table as well. And the majority of the increase from the prior year in total reserves is the case reserve category. And what that represents is claims that were approved and open and that are currently being paid by Aflac, and it just represents the remaining amounts to be paid over the remainder of the leave. So that's the main driver of the increase in reserves year over year. We had outside consulting actuaries also review the reserves and concluded that they were fairly stated in relation to the financial statements. The next slide covers a new accounting pronouncement that was effective this year, and it relates to subscription-based technology agreements. And what that really represents are cloud-based software. You've got some arrangements with cloud-based software, and it requires the authority to gross up the balance sheet to basically put a right of use asset and a liability on the statement of net position. You can see in the column on the right-hand side, it was adopted on July 1st, 2022. And there was no impact on net position when it was adopted. The amount of the asset equaled the liability. The left-hand column, you can see where it ended up at the end of 2023. And there was a slight variance between the asset and liability. And that just relates to the fact that the asset is being amortized on a slightly more accelerated basis than the liability is being reduced. So that's just a new pronouncement this year, that there are some new numbers that are reflected in the financial statements. And under the pronouncement, we were not required to restate the 2022 financials, just to show the impact in the footnotes to the financial statements. Damien will go through the investments on the next slide and provide some commentary.
Yes, thanks, Chris. So the next couple of slides just highlights a couple of larger balances on the statement of position. So the first line is investments, just increase from prior year from 370 million to 486 million. And this is just driven by contributions that were received that are put into the state short-term investment fund, based on the fact that it's been at a higher level for the current year for 2023 compared to 2023 averaging. It did have a lot more investment income in 2023. This is coupled with just an increase in the effective interest rate in 2023 compared to 2022. The next 2 slides talks about the defined benefit pension plan that the state employees participate in. There are the service plan and then the other post-retirement employment benefit plan. Both plans, the liabilities related to these are developed by independent actuaries. Kevin and McDonald does the actuarial valuation for the service plan, and the Siegel Group does the actual actuarial valuation for the OPIP plan. Both are then allocated based on the authority's proportionate share of their contribution. So for 2023, the authority's proportionate share for the service plan was 0.428% compared to 0.215% in 2022. And for the OPEB plan, the authority's percentage share was 0.0623% in 2023 compared to 0.0264% in 2022. And these are some of the primary drivers for the changes, the increases in the liabilities year over year. The state auditors of public accounts audited these numbers and the allocations that were provided to the various agencies, to the authority, to just ensure that the numbers and the allocation looked appropriate, and the authority's management booked those amounts based on those estimates. So the next slide just really shows the numbers as presented for the OPEB plan. The final slide, I think Chris is just going to summarize the financials here for some highlights.
Thank you, Damon. This really culminates what we've been speaking about this morning. It really brings everything together in showing the changes in the fiduciary net position in 2023 compared to 2022. You can see the positive impact of the increase in contributions. They went up $28 million this year. And you can also see, as Damien referred to, the investment income increased by $16 million in 2023. And these increases were offset by $178 million in increases in expenses. And the increase was primarily driven by a full year of benefit expense in 2023. You can see overall at the bottom that the fiduciary net position increased by $107 million in 2023 and stands strong at $547 million at the end of the year. So again, that compares to the prior year fiduciary net position of $440 million. We went through these numbers in greater detail with the Finance Committee. So certainly I don't want to bore you with much more information, but we really attempted to cover the highlights this morning. And I'd also like to thank management for their cooperation during the course of the audit. It was a good audit effort by management. I also would like to thank the board for the opportunity to serve the authority and to meet with you this morning. And that really concludes our formal presentation. I'm not sure if there are any questions that you may have at this point. I apologize, we went through things too quickly. I just want to try to be sensitive to your schedule this morning and not
Thank you.
Details.
Thanks, Chris and Damon. Until or if there are no questions, Aaron, anything you would like to add, or Holly as the committee chair for finance? Happy to take any last comments too.
No, I have nothing to add this morning, but thank you.
Okay.
I have nothing to add other than to thank Markham for working with us cooperatively. We appreciate their outside independent view of our operations and helping us to stay on track.
Thank you, Aaron, and thank you, CTPLA team. And our contact information is included in the slide. Also, it's available from management. If you have any questions after this meeting, feel free to reach out to Damien or myself. We'd be happy to answer those for you. And we're here to serve the authority. So thank you very much for your time this morning.
Thank you, Chris.
Thank you.
Thanks. Take care, everyone. Have a good holiday season.
Okay, Walter, can we turn to you now to provide a fund recovery update, please? Yep.
Walter, you're on mute. There we go.
Oh, thank you. Good morning, everyone. So in September, I kind of provided a update on our fund recovery notices that did kick off in July. So today is just a follow-up on that meeting. As a reminder, in July, we did kick off our notices for non-compliant employers. We've sent out 3 quarters of notices so far. In November, we did send out our Q3 of 2023 notices. To date, we've sent 59,482 notices out for 30,749 unique employers across Q1, Q2, and Q3. At the end of November, in the 5 months that we've implemented our notices, we've had 6,265 employers that have come in and paid those past due notices. They have paid $1,959,653 for all 3 quarters. We've seen the largest number of employers and contributions among our Q1 2023 notices. For many, this served as the reminder that, oh yes, we do have a deadline when things are due. And it has helped keep people honest and fair to us in our most recent quarters. But we have seen some additional responses from Q2 and Q3 as well. So for our outstanding base principal, we have collected $1.531,276, interest $29,881, and then penalty $398,496. As of yesterday, I can say that we have surpassed the $2 million mark in payments that have come in from our penalty notice. And we have seen, we are up to about 6,600 employers that have come in and paid those notices. Another impact of our notice outreach is that the employer counts that we continue to work through, update, and indicate who are no longer covered by our program. As of the end of November, we've updated in our count over 10,108 accounts to either mark as closed, no longer having Connecticut employers, some duplicate accounts, as well as employers that never should have been enrolled in our program in the first place. We continue to work with the employers directly through our case management system. However, we've also been successful in working with our partner agencies, the Connecticut Department of Labor and with the Connecticut Department of Revenue Services, as well as our third-party administrators to review the data that they're submitting to us. Through these partnerships, we have made about 58% of our total account status updates in our system. And then some additional updates in January. We'll be handling off what's currently outstanding in our system that are still open, remaining to be paid to a third-party fund recovery vendor. As of the slides preparation of last week, we had 27,160 notices for 15,850 unique employers still open or outstanding in our system. We are, however, still continuing to work on reviewing the data in our system, the reports from our third-party administrators, as well as data from the Department of Revenue Services and Department of Labor to clean up this before we do hand it off to a fund recovery vendor. One of those services also being provided by our fund recovery vendor before they place the file and send out any letters to the employers is to continue to help scrub our data and review across public records. We are still seeing some employers that are closed before we actually receive data in our system, but still open within those third-party administrator relationships. So this will be a huge benefit. And we do see about 11,000 unique employers across all 3 quarters. So in scrubbing our files for our Q1 and Q2, it'll also help clean up our Q3 notices that are still outstanding as well. The second part of our notices has really been our cases that have come in from our employers, our third-party administrators that our finance team and our contact center have been reviewing. So this slide kind of reviews some of our case management inquiries and responses. In the last 5 months, we have received 8,668 inquiries or cases coming from our notices. The largest response from our notices is from our initial July notices, where we received 2,867 cases. And then we have started seeing a decline in our most recent months. We're currently averaging slightly less than 400 new cases per week. And as of last week, we've also closed 7,470 of these cases in our system. 3,862 of those inquiries were closed as valid disputes. 1,041 were invalid disputes. We've seen about 773 duplicate inquiries into our system. We've additionally had another 667 business closures or status updates in our case management system. And we've had about 600 cases where we've tried multiple times to get additional information from these employers to validate their inquiry, but we just haven't received a response. We've additionally seen about another 500 cases where we're just providing some guidance, some of our how to pay guides, how to file an amended return if they filed something incorrectly to begin with, as well as just general questions. As of my last update in September, we had provided 14,997 updates and actions to 4,616 cases. We were averaging about 3.25 actions per case. As of last week, we're currently up to 41,320 updates actions to cases, and we had worked uniquely amongst each of my team members 13,682 cases overall, meaning sometimes multiple team members are having to work a case as we're being provided additional information after we had initially closed it. We're trying to give time for those employers to respond to us and vet all of their concerns or questions. But we have seen our efficiency go from 3.25 to 3. So we have been more efficient in handling a case and handling it less times per case. And that means we've been able to work more cases. Our actions per day was trending at 325, with us touching 190 cases per day. And we had closed 67 cases per day. Currently, we are up to overall 386 actions per day, 216 cases touched per day, and 73 cases closed per day. But in our most recent 6-week period, we've actually been averaging higher than that, 256 cases per day, 466 actions, and then 85 cases per day. So that means we're now able to act and close more cases per week than what we're getting in, and we're making some headway there. Before we do send our notices to January, we will be vetting everything up until the end of this week, definitely next week, we think is realistic as well. Another benefit of our notices is that we've continued to receive cases from employers where we just didn't have any contacts on those accounts. So we've been able to work with them where they've been enrolled by a batch TPA, and we've been able to add 2,111 contacts on 1,717 additional employer accounts. So we're continuing to enhance our registration base and add those employers that are now going to get our communications across the whole. So I'll pause here if anyone has any questions on our notices and case management. And
that's seeing any, Walter. I think you're good.
Thank you so much. Okay, so thank you.
Great. Any questions for Walter before we move on? Okay, great. Thank you. Amazing amount of work. Thank you so much for that report and update. Let's turn to the committee reports, please. And Mike, I'll have you go first with policy and personnel, please.
Okay, good morning. Our committee met this month and we received an update on private plan renewals from Michael. And we had an initial discussion regarding creating a CEO performance evaluation process, and a discussion that will continue into our at our meeting in January. Thank you.
Great. Any questions? All right, let's Molly, move to outreach and engagement.
Happy to. So the committee met in November. We heard updates from Jessica, from Maddie, and from Nancy. So covering outreach engagement, led in the podcast. And we did want to let folks know that we will not be meeting in December because of the holiday break. So we'll see folks again in January.
Wonderful. Thank you. And Holly, finance and audit.
Yes, so we met last month and we heard from Markham on the audited financial statements that you have already been presented, and we also went through the most recent financial reports, which Dave is going to present to you now.
Good morning, everybody. Thank you for joining us this morning. Let me know when you can see my screen, please.
Your screen, Dave.
Thank you, as always, Stephanie. Okay, so we're going to go over the results for the month of October and a preview of November with a projection for year end to see where we think we'll end up by June 30 of 2024. So for October, we had expenditures of $932,000. That was $281,000 better than budget. Overall, we were almost $333,000 better than budget. And that was because we had some fund recovery penalty revenue, as Walter had just discussed. And so we got $56,000 for the month of October, which led to a positive variance of $51,000. The expense categories for the month of October were the typical ones: payroll and benefits, contact center, outreach, IT consultant services. No big surprises there. Moving on to bond activity, there wasn't any for the month of October. We didn't spend any bond money, so things were as usual. We did have budgeted that we would have bond proceeds coming in October. That didn't happen. We'll be broaching that later on in the fiscal year. But for now, we are about $123,000 behind budget. But that's because we had some expenditures in this fiscal year that we paid that we thought we would pay last fiscal year. Most of those being the website redesign and replatforming that went live a few months ago. Moving on. 1 second, please. Okay. Moving on to where our bond money is sitting at the end of October. We have expended about $13.5 million out of the $16 million allocated. That leaves us about $2.4 million remaining that's available to the authority to spend. Moving on to the contribution activity for the month. October is a month when the contributions come in for the third quarter of the calendar year. So we got $103 million in. That was $1 million more than we had budgeted. The other big piece of the month was benefits paid. It was $29.4 million. That was $2.4 million less than budget. So we did do better than budget. But that translates to about $7.4 million a week paid in benefits, which is a new weekly average high for a month. So we are seeing a trend where benefit payments are increasing. Overall, for the month, our activity was $69.4 million, and that was $4 million better than budget. Again, the main drivers of that being lower than expected benefit activity and higher than expected contribution activity. Year to date, our activity has been $93.9 million. That's $18.8 million better than budget. And again, the main drivers continue to be lower than budgeted benefit activity, higher than benefit contribution activity. Also, investment income is better than budget because the current rate we're earning now, which is just a little bit under 5.5%, is better than what we budgeted, which was just a little under 4%, leading to where we are now. Since this is the latest quarter for contribution activity, just wanted to summarize where we've been so far with contributions. If you look at the third column and the gray column, it points out our contribution activity for the quarter, which is $106.9 million. It is lower than first and second quarter, but that's always the trend that we see and have seen for the past couple of years. The other trend I will note is that contributions have gone up year over year. The $106.9 million is about 4% higher than it was last year at this time, which is in line with our year-to-date trend, because year-to-date we're about 4.3% ahead of we were last year. So contributions are trending so far as expected. No big surprises. The contribution fund as of the end of October had $592.4 million in it. And so that's where the fund is at the end of October. Just a quick view of the balance sheet. Our total assets are $611 million. And the biggest asset is the short-term investment fund at $573 million. And there's another $12 million that continues to be in the impressed fund at Aflac. And we had $6 million in transit because it was a big month, because that's when the contributions were due. Moving on to the month of November. Again, it was pretty typical month, $1.1 million of operating expenses. Again, the typical categories, no big surprises. Licenses, we paid an annual fund recovery fee, so that was a little higher than normal. We paid some maintenance to DOL for the appeal system, and we paid 4 quarters to be current with them. But other than that, it was business as usual for the authority. Contributions for the month of November were over $29.5 million. Again, that's averaging to about $7.4 million a week. So that's what we're trending so far. Contributions were $659,000, and interest income was about $2.5 million, which is pretty typical for what we expected in November. So we are starting to do projections now for the fiscal year end, now that we've got a few months of activity under our belts. By the end of the fiscal year, we expect expenditures to be $1.9 million ahead of budget and coming in at $15.4 million. Don't be alarmed by the net income variance. I know it says that's a negative $2.4 million. Just as a reminder why that is, there is a negative $5 million for the administrative fees. And that's because in the first fiscal quarter of this year, back in July, we did not transfer $5 million because we had enough money in the operating reserves. So we kept the money in the contribution fund where it earns interest, because it made more sense to keep the money where it earns interest. And also we've had a positive variance of fund recovery penalties to date of $688,000, which is significantly more than what we budgeted at the time, because when we budgeted, we really weren't sure what the fund recovery activity was going to be, so we budgeted very conservatively. But I'm happy to say, thanks to Walter and his team, we expect to have $710,000 by the end of the fiscal year. So that's where we are in terms of our operating budget. In terms of our projection for the contribution fund, we did work in tandem with our actuaries over at Spring. So working with them, we expect our net activity by the end of the year to be almost $68.5 million. That is $55.6 million, better than the original budget. We are expecting contributions to come in about $11 million more than what we budgeted. We are expecting benefits to come in $36 million less than what we budgeted, coming in at $364 million. So that's where we are, or where we expect to be at the end of the fiscal year, and where we are for the months of October, and a sneak peek into November. Does anybody have any questions?
Okay, well, thank you, Dave, so much for all that work, and to the Finance Committee for the review prior to today. I think we're good. All right. Aaron, I would love to turn it over to you now for your CEO report.
Thank you so much. So I have a few things to talk about, so I am going to share my screen. Try to get to
your screen, Aaron.
Thank you so much, Steph. So next month we will be doing the sort of what has become our tradition of kind of sharing where we've been and where we're going, but I wanted to give you kind of a sneak peek in terms of where we are with benefits. You will see that we have grown quite substantially compared to where we were in our first year. So the number of payments has increased by 34% when you compare year to date for 2022 through November versus year to date 2023 through November. The number of Connecticut workers who've received benefits has increased by 37%. The number of total funds paid has increased by 38%. So as we keep saying, the past is definitely our prologue in terms of where we are with the claims volume. They are increasing, the benefits are going up. So minimum wage is going to go up, which means our benefit amounts will be going up in January. And these numbers, I think, just continue to show the results of our outreach, the results of greater maturity, and continue to show that we can't just assume that where we were before is where we will end up. This slide, which John put together for me, shows our trend. Even though it's a little bumpy, because when you look at variations between weeks, the trend is clearly on an upward path. So CVS is going to call me and tell me that I have prescriptions waiting. I apologize for the background noise. So the other thing I wanted to share with you was work that our team, particularly our legal team, has been doing on private plans. We had our largest tranche of private plans get approved in the first quarter of 2021. That was they expressed their intent to have a private plan and therefore did not have to pay any contributions into the public program. We had 230 private plans, therefore, that are due to expire at the end of this calendar year. The legal team has been working the past 6 months to make sure that those private plans were aware that they were going to expire, which included outreach to the employers, to their insurers, honestly, to anybody who we could think of who could possibly get in touch with these people, because some of these private plans did not keep their contacts up to date with us. This chart shows sort of the results of all of that outreach, particularly in the last few weeks, because lots of people waited to the very end to let us know what they were going to do. The majority of private plans did file new applications, so they are going to continue to be a private plan, although we have almost 3 dozen that are going to return to the public program. We have a couple that we had given them an extension of time. They have submitted their new applications that are pending. And we have 1 business that we know is closed as a confirmation. That still left about 4 dozen plans that we just like, what's actually happening with you, which is significantly better than the 126 that we had in November. Of those 4 dozen, we have communicated with almost all of them, except for 10. We have 15 that have come in and said, we're still working on our new application, but we're going to get it to you before the month end. So we've allowed that to happen. We have about a dozen that we have reason to believe are no longer in existence, or possibly have merged or been acquired by other entities, based on collaborating with all of the work that Walter's team is doing. We're using that same information. We have a handful that have told us that they do not plan on renewing their private plans. They would rather come back into the public program. They haven't given us the official form. They've just been emails. And then we have 10 who are just MIA. So they haven't responded to any of the outreach efforts. Our efforts to communicate with their insurers haven't borne any fruit. So barring any change, those 10 employers will all return to the public plan as of January 1st. An email notice will be going out to them tomorrow, letting them know what they need to do, what they need to advise their employees, so that the employees will know that come January if they have any claims that they need to bring the claims to us. So I think it's one, I want to thank the legal team for all their work. Michael, Joe, and Kathy have done a lot of work to try to keep on top of this. But I also think it's really important to just point out that unlike some of the other states, our private plan population has remained relatively consistent. So it's a valuable option for employers that want it, but we're not seeing giant spikes, and we're not seeing employers sort of running away from us. Rather, we're seeing many of them coming back. So that's, I think, a good sign for us. Number 3, quick reminder, we sent out 2 forms to all of the board members. A few weeks ago, we asked you all to update your contact information. We've also asked everyone to give us information about your community or other organizations that you belong to. As we engage in outreach, it's very helpful to know that someone is on their board of directors for the American Heart Association, or the Boys and Girls Club, or whatever it is. So we just ask that you share that information with us so that we can continue and improve our outreach and engagement efforts. So please complete those forms and get them back to Amber. Finally, speaking of the Boys and Girls Club, we partnered with AFLAC to do a toy and food drive to benefit the Hartford Boys and Girls Club. We're a small team, and we really were very, and since we're remote, it's a little bit tricky to get people to go to a single location, but we set up a donation box at 450 Columbus, and I'm really proud of us because we really rallied and provided over a dozen bags of food, another dozen or plus bags of toys and activities, and $175 in gift cards that Jessica and Maddie collected earlier this week and brought to the Hartford Boys and Girls Club in conjunction with AFLAC, which also engaged in a similar effort on their location in Windsor. And so we just wanted to share our efforts there to join and assist our community in as many ways as we can. So just wanted to let you know that we were doing that. If you follow us on social media, which you should, you will have seen the reel that Jess put together and posted yesterday. So those were the things I wanted to let you all know about. I'm happy to take any questions.
Any? Sorry, I know Erin's dropping her.
Trying to stop sharing. There we go.
Thanks. Any questions? Any questions for Erin? Thank you for the updates, highlights. Okay. Seeing none, we have a quiet group today. Do we have any old business? Any new business? Would anybody like to make the motion to adjourn?
Motion to adjourn.
Second, with a wish of happy holidays.
Yes, thank you, Andrea, for the second. All in favor?
Aye.
Aye.
Nobody's opposed or abstaining, but please do say so if you are. Wonderful. So it's 9:44. We're going to adjourn the meeting, but yes, with a very heartfelt, happy, and healthy holiday season to all. And we look forward to seeing you in 2024. All right.
Thank you.
Thank you all so much.